Well, Marc Franklin is with us, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments. Thank you very much, Marc, for joining us. Good morning. So it's a red letter day, no other way to put it, at least for US. How would you look at this? I mean, much has been sort of talked about, much ink has been spilled, lots of views out there. But let's try and look ahead, Marc. Is there any way this turns out to be good for the US? I don't know how, but you've got to ask that question in the medium term and beyond. While it's very, very red and it's a bit of a detox, I don't know if I can use that word, but what's your sense, Marc?
Yeah, good morning. Let's try and understand what the objective is here for the US administration. The objective is to try to rebuild the industrial base of the US economy, which will give it a stronger geostrategic foundation. It's also attempting to effectively bring down the fiscal deficit and the trade deficits as well. And some of the things that have already happened begin that journey. So one example is that bond yields have fallen in excess of 60 or 70 basis points since the start of the year. So that part of the fiscal expenditure, which goes on debt servicing, is already starting to come down. Whilst we don't have tangible numbers yet on the progress that the DOGE department is making, there are clearly some additional incremental progress is being made in terms of cutting government spending as well. The trade deficit is definitely going to take longer. It takes a while for domestic producers to gear up, invest, and to expand capacity. But then the final point as well is the desire to try to onshore jobs, onshore investment, and so on. And there, what is likely to happen is even if domestic production fills the gap that's being created by importers withdrawing or reducing their market share, a lot of any incremental industrial production will be automated via robotics. So it's not entirely clear that a swathe of new jobs will be created. These are all long-term objectives with some initial progress being evident. But what is unavoidable is the short-term dislocations that it will cause, not just in terms of economic activity via higher uncertainty and reduced investment and spending decisions, but also some inflationary pulses that will kick in as a result of these very elevated import tariff increments that have been introduced with immediate effect. So short-term pain inevitable, long-term gains potentially, but it's going to take a while to realize.
And the short-term pain is, really looking very painful, Marc, with the kind of immediate drawdown in markets. Just try to understand, how you would perceive a market like India, because it's all getting very, very granular and specific now. The belief is that maybe we're relatively better off. But what would your take be?
You're right to highlight that structurally, India's economy is less open to other emerging economies globally. Domestic consumption, domestic investment, much bigger drivers. And therefore, by extension, major disruptions to global trade activity or effectively deglobalization should impact India economically and fundamentally less. That being said, though, it is an equity market, and equity markets are very much psychological in nature. And if other markets outside of India, such as the US, but also other emerging markets, see a flight of capital towards safe haven assets, India will be correlated to that as well. So it's more of a relative assessment that there is a certain degree of resilience that India has structurally, but inevitably any prolonged pressure on risk assets more globally will find its way in terms of the impact on psychology for domestic investors in India as well.
So in light of that, what would you suggest would be a good asset allocation strategy? Do you think overall there should be a reduction to equity? And if that were to happen, then where do you go? You go to bond, you go to gold. Gold is anyway on a bull run. How do you look at, asset allocation at a time like this?
It's inevitable that the focus will be predominantly on equities because there we're seeing some pretty sizable moves to the downside. But that does ignore the fact that some asset classes are doing rather well at the moment. You highlighted bonds. We've been positive for some time on the shorter end of government bond curves as a result of this repricing of growth expectations off the back of the tariff policy announcements. And then a subset of fixed income that we also really like as well is shorter dated Treasury inflation protected bonds. These give you some degree of protection should inflation start to pick up again in the coming months, but the Fed remains somewhat dovish in order to try to stabilize the economic activity outlook as well. So there are certain asset classes that are doing rather well, but of course we have to still maintain a certain degree of diversification in portfolios. You mentioned gold. We have a long-term secular positive view on gold at Manulife, but in the near term, we are starting to lock in some gains tactically because of the relative outperformance that the commodity has experienced, and the likelihood that central banks will probably pause their purchasing activity at these relatively elevated price levels. But we're looking for entry points again on gold over the medium to longer term. Certain commodities as well will be caught up inevitably in this downdraft in terms of risk appetite. But there are commodities such as copper that are going to experience some pretty profound supply deficits in the near term, which will certainly put a floor underneath pricing should there be a bit of a pullback. And we are likely to see sort of second-order effects off the back of the US government policy announcements on the trade and tariff side. It's much more likely to induce economies such as China and potentially Europe as well to stimulate their own economies domestically on the fiscal side at the very least. That will have knock-on benefits for industrial metals demand, but in the near term, they will be caught up in this bout of volatility.
Marc, then finally, just quickly, equities. What is your preference? Which markets and in what order?
So if we look at sort of factors and sectors, we are quite more comfortable being exposed to the higher dividend-paying, quality dividend-paying sectors and parts of the market. Reason being that, we're a total return investor. So in an environment where capital returns are initially somewhat challenged, you have that income stream kicking, which will help to sort of provide some ballast to portfolios. In addition to that as well, we're going to have to refocus on corporate fundamentals and be positioned into those businesses that are somewhat more immune to the disruptions that are being caused by government policy initially in the US, and have the ability to pass through price increases as a result of higher import costs as well. So we're in a more selective phase of market cycles. And then from a factor point of view, perhaps pivoting more towards high dividend growth type business models.
All right. Marc, thank you very much. Good speaking with you. Appreciate you joining us and running us through what you make of things. It's a fluid situation, and there is a fair bit to track.